Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate filings, hoping to turn spreadsheets into stories. Today we are diving into a recent report from NRG Incorporated. They announced some big moves and funding updates that could really shake up their business. So what is the big news? Well, NRG Energy has agreed to buy a whole chunk of power generation assets from a company called LS Power. We are talking about around 13 gigawatts of natural gas power plants and a substantial virtual power plant system that can handle about 6 gigawatts. This is a pretty massive deal, potentially adding significant capacity and market share for NRG. The deal announced back in May involves NRG buying up equity interests in several entities that make up this portfolio. Think of it like buying several companies that together own these power assets. It is described as the LSP acquisition. Now, NRG has given us a hint about what they expect from this acquisition. They are projecting that these new assets will add about $600 million to their consolidated adjusted EBITDA. This metric, adjusted EBITDA, is a way for companies to show their operating performance by stripping out certain expenses like interest, taxes, depreciation, and amortization. It is a commonly used measure to gauge profitability and cash flow from operations. What is particularly interesting is that this $600 million figure includes an estimated additional $800 million in what they call revenue enhancements. These enhancements are expected to come from things like better prices for electricity capacity and also higher energy rates. They are saying some of this is already under contract, which is good news, showing concrete steps are being taken. They expect to see the full benefit of these revenue increases within about 18 months after the deal is finalized. But of course, there is always a caveat, no guarantee. These numbers will actually materialize. To pay for this massive acquisition, NRG is also undertaking some significant financing maneuvers. They are conducting what they call concurrent offerings of senior secured notes and senior unsecured notes. Basically, they are selling different kinds of bonds to raise money. This includes raising money through first lien secured notes that will mature in 2030 and also ones maturing in 2035. These are typically considered safer investments because they are backed by specific assets of the company. Alongside these, they are also offering unsecured notes that mature in 2034 and 2036. The unsecured notes have longer maturity dates but are not directly backed by specific assets, making them a bit riskier for investors, but potentially offering higher returns. The company states that the success of one offering is not dependent on the other, which gives them flexibility. Beyond the big acquisition and the financing, NRG is also making strategic moves in Texas. They have secured loan agreements with the Public Utility Commission of Texas under the Texas Energy Fund. One loan for $216 million was finalized in July of this year to help develop their Taunton generation facility, which is currently under construction. This loan has a fixed interest rate of 3.000% and matures in 2045. A significant portion of this loan has already been disbursed. Looking ahead, they anticipate another substantial loan of $562 million in September. This one is earmarked for their Cedar Bayou generation facility. It is also expected to have a fixed interest rate of 3.000% and a similar maturity date in 2045. An initial disbursement of $200 million is planned for September 2. These loans show a commitment to developing new generation capacity and leveraging state programs to finance these projects. The report also lists a whole host of financial statements that are being provided in connection with these offerings. This includes audited and unaudited financial statements for various subsidiaries and projects that are part of the acquisition. It is a lot of detail for anyone looking to do a deep dive into the financials of the acquired assets themselves. They have included the press release that announces these financing and acquisition details, which gives us a good overview of the information they are putting out to the market. Critically, for understanding the combined future of NRG and these new assets, they have also included unaudited pro forma financial statements. These statements adjust the company's financials to reflect the LSP acquisition as if it had already happened. This is really important for investors to get a clearer picture of the expected financial state post-acquisition. We also see consents from their independent auditors. This is standard practice confirming they stand by their audits of the various entities involved. Now let's talk about what this all means, right? NRG is making a massive bet on growth with this LSP acquisition. They are not just buying more power plants, they are aiming to significantly boost their profitability through these revenue enhancements. This strategy signals a strong belief in their ability to manage these diverse assets and extract more value from them than their current owners. The focus on natural gas generation also suggests a continued reliance on these fuels for the foreseeable future, despite the broader energy transition discussions happening globally. The financing strategy is also quite telling. By issuing both secured and unsecured notes, they are balancing risk and cost. The secured notes with lower interest rates provide a stable base, while the unsecured notes, especially the longer-term ones, could offer them more financial flexibility. It shows they are actively managing their capital structure to support this large investment. The Texas loans are particularly interesting. This strategic use of government-backed funds like the Texas Energy Fund to finance new developments like the Wharton and Cedar Bayou facilities indicates a smart approach to capital deployment. It can lower their borrowing costs and support critical infrastructure development. It also shows they are aligning with state energy priorities. However, there are always risks. The success of this strategy hinges on NRG achieving those ambitious adjusted EBITDA and revenue enhancement targets. If they underperform or face unexpected operational issues, the burden of the new debt could become significant. The energy market is also constantly evolving with regulatory changes and technological advancements. Their heavy investment in natural gas assets could be a long-term risk if the transition to renewable energy accelerates faster than anticipated or if carbon pricing becomes more stringent. Overall, NRG appears to be in an aggressive growth phase, aiming to consolidate its position and enhance earnings. They are taking on significant debt and operational responsibility, but the potential rewards in terms of increased cash flow and market influence are substantial. Investors will be watching closely to see if they can successfully integrate these new assets and deliver on their projected financial improvements within the stated timelines. Alright, that is our breakdown of NRG Energy's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this acquisition is a masterstroke or a risky gamble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us keep these videos coming. And of course, subscribe for more deep dives into the corporate world. And hey, don't forget to check out our Discord community linked in the description for more discussions and real-time insights. Thanks for watching. See you next time.